Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. David, plenty to discuss this week. Lots going on.
Hello, Sarah. Yeah, it feels like spring's in the air, but you take one look at a Bloomberg screen and it is a sea of red today.
Yeah. Okay. Actually, I'm not laughing because it's not funny. Okay. But before we get to that, quick fire numbers round. Do you want to go first? I always let you go first, but you go first. Come on.
You do. It's very, very generous of you. Okay. My number, hopefully it's a fun number. My number is 500.
Okay.
It is the number of cat figurines, bear with me, number of cat figurines that have been stolen from a new Gordon Ramsay restaurant, which I think is on Bishopsgate in the city.
Right.
And it's called Lucky Cat. And the thing about Lucky Cat is, you're familiar with the Lucky Cat, the
waving cat you see
exactly.
in the window of sort of Asian restaurants and things.
And I am reliably informed that this restaurant's theme, its motif, is these lucky cats, and there are thousands of them. But in the first, not in the first week, but in 1 week alone, 500 cats have been stolen.
Right.
And Gordon Ramsay has said, "Look, this is costing me £2,000 to replace them, so we might have to put the cats." We might have to put the cats behind glass, or I don't know, glue them down or something. So
lucky for who is my question.
Lucky for you. By the way, I'm rounding. It's 500. The technical number is 477, but
okay.
I think we'd have to get Gordon on to Need to Know to get an exact, reliable figure.
I'm not sure we can do that. I don't think we can stretch to that. Anyway,
right.
Okay,
so what's your number?
My number's 3.
3. Wow. Go on then.
It is the number of times that Fort Knox has opened its doors to non-authorised personnel in its history.
Wow. And that's in real life, not James Bond sort of...
Exactly. Yeah. And that's not kind of Mission Impossible, kind of coming down through the ceiling or anything. Do you want to know the dates when that's happened? Or do you want to guess when?
Yeah. I mean, I'm thinking of big sort of diplomatic... was it one at the end of the gold standard? Tell me, come on.
Yeah, so 1943 was Franklin Roosevelt went in to have a look. And then in 1974, 10 members of Congress went in to, in inverted commas, break down cobwebs to reassure public their gold was safe. And in 2017, there was a delegation including Senator Mitch McConnell and Stephen Mnuchin, who described it as being freakishly well secured.
Yeah, well, this is it, isn't it? Right now, there's obviously renewed interest in what's it called? The United States Bullion Depository, I think is the technical name for it, Fort Knox. And the current president has said a number of times that he wants to go in and see the gold. But it's a popular misconception because most of the gold isn't stored there. In fact, the vast majority of the world's physical gold is actually stored at the Federal Reserve Bank of New York.
Yeah.
And, made famous, of course, by the Die Hard movie with all of that gold, neatly sort of stored in cages being carried off in giant articulated lorries. But really fascinating. That's brilliant.
So there we are. Good. I like yours too. Okay. So it's a sort of market movers sort of theme this week, I guess. So what are the 3 topics that we've decided upon?
Yeah. Okay. So we won't go into tariffs in a huge amount of detail, but we'll touch them a little bit because for those listeners that are interested in tariffs, we've got a whole pod on tariffs there's a Coutts.com article, a number of them that I've written on tariffs. So, but it is a real feature in markets, obviously today and yesterday with the recent announcement of US and Canada tariffs. So we're going to talk about some market moving themes. The first one though isn't that. It's going to be the US crypto reserve, which was announced over the weekend, late last week.
Yeah.
So we love Bitcoin on the pod, and everyone knows my deeply skeptical views of it. But nonetheless, I think we should talk about that because that's interesting from a political economy point of view.
Yeah. Could be a game changer for cryptos, couldn't it?
Possibly. Again, you can sense discussed. My intrepidation.
Exactly. To be discussed.
I'm such a neophile. I'm so bullish on new tech, but I just can't get behind this as a currency, as you know. Right. So the US Strategic Crypto Reserve will be our first topic. A second topic, we'll have to talk about growth. Now, we've had some growth jitters, some cracks appearing perhaps in some of the underlying data. And I want to put those into context and bring those to life a bit because it's not all doom and gloom. And then what flows from growth is the other side of that, which is inflation and the pathway for sort of rate cuts, I think.
Yeah, and obviously bond markets and how I guess the fact that they're incredibly volatile at the moment, aren't they?
Incredibly, and probably will be for the next few months.
Yeah, okay. Well, let's start off then. Is this announcement that there would be a US strategic reserve of digital assets, which would include but not limited to Bitcoin. I guess the rationale about that is it's about making the US the crypto capital of the world. But it's so volatile. Surely that's quite a risky move, isn't it?
Well, you're quite right. It's not every day, though, that a US president moves a $300 billion market just with a couple of social media posts. And that's exactly what happened last week. You're right. It's not just Bitcoin. You've got Ripple, Solana, Cardano as part of this potential holdings. I mean, a lot of the detail here yet hasn't really been fleshed out. The FBI obviously has got a huge amount of Bitcoin, which it seized many years ago in the famous Silk Road raid. So it's unclear where that might go. But look, the impact was immediate. So you saw a huge sentiment rally in crypto. I mean, you added, by my estimations, around 330 billion to the market cap in 3 hours. And that's reversed. I mean, the roller coaster ride of this asset class never ceases to amaze me. That reversed a good portion of the 400 billion sell-off that you've had since February 20th. But I suppose your question is, well, what does it mean? What is this, and where does that money come from the crypto reserve? And when I thought about this, because again, the detail is forthcoming. We've got this big White House crypto summit this Friday where we're going to see the president meet with these various founders, CEOs, and investors to shape that policy. But where does the money come from? And I think there's only two choices. I think you either raise taxes or increase government debt to buy crypto. And either way, I think the cost lands on the taxpayer. And I think, when I was sifting through this over the weekend, Elon Musk, I think, summed it up pretty bluntly that government debt can only be repaid through future taxes and future inflation or default. So you've got interest rates, interest rate payments on government debt rising. Okay, they're not at the heady levels of the early 90s, but they've gone up significantly. And where the government holds gold or foreign currency, or crypto, I'm not sure. I mean, it just opens the door, I think, to this kind of let's call it potential favoritism, where basically individuals or groups, or even companies to an extent, who hold large holdings of specific assets could get a windfall that ultimately is paid for by the taxpayer. So I think it's interesting. I mean, I'm not sure really what this is trying to do. Like, remember, the whole reason the dollar has global reserve currency status is because of the confidence we have in the American system of checks and balances. And to say that we no longer have confidence in that and we have to have this diversifier, that's this crypto repository or strategic reserve, it kind of flies face in this idea of the current administration's desire for dollar supremacy. So I'm eagerly anticipating what's coming this Friday by way of detail.
Yeah, I mean, I guess I raised the point, and we've discussed before about the volatility of cryptocurrencies. I suppose one argument would be that being held within the US Strategic Reserve would add legitimacy to the asset class. So in theory, that could reduce volatility, couldn't it?
Well, I don't know. I mean, the market is very unclear sometimes, some of the volumes that are traded on this market. And you have a lot of what's called exchange washing, that is basically artificial volume that is created on some of these crypto exchanges. So it's if you try and do analysis on this asset class, you have to take into account for a fact that sometimes the numbers aren't what they purport to be. And the government is both potentially a big buyer or seller of this asset class. Could create quite a lot of volatility in theory. I mean, I'm not again. I don't know the detail. I don't know how the treasury operations would happen and how they would trade it, how they would hold it. It feels like a policy, a rallying cry to that policy that was alluded to on the campaign trail. But as I said, very little detail. I mean, I'm not surprised that something like this happened, but the execution of it is going to be key, I think, here.
Yeah. Okay. So watch this space. A lot of questions still to be answered. Okay. That's crypto growth. Now there have been, as you say, perhaps a little bit of a wobble in that sort of expectation that everything's fine, we're all good, economy's just going to keep growing.
Well, this is the contrast with our first topic, right? So while crypto markets were rallying late last week, I think there was a slight hesitancy that perhaps the broader economy is showing signs of slowing. So let's focus. I'm a eternal optimist. Let's focus on the good news first of all. Like, the good news is that wages grew in January and inflation moderated slightly. And personal income, after you adjust for inflation, actually grew. Okay, these are good, healthy signs.
Yeah. Are we talking about the US here or UK or both?
We're talking about the US here.
Yeah.
The bad news, on the other hand, is that people aren't actually spending that money.
Yeah.
And you saw there's quite a key metric that a lot of people follow, which is the PCE, the Personal Consumption Expenditures Index. And you saw, since the first time since March 2023, it fell. Not much. 0.2% in January. But the point is, despite rising incomes. And then you also saw another indicator, the savings rate, jumping. So it's a sign that people are cautious, consumers are holding back rather than circulating money through the broader economy. And that aligns with the backdrop of other data we see showing consumer confidence has been dented a bit.
I was going to say that was going to be my point. A lot of the sort of negative data points we've seen in the US are more sentiment related, aren't they, than hard numbers. They're just a general feeling of, I'm feeling a little bit less confident about things, to do with all sorts of factors, whether it's the potential impact of tariffs or whatever it might be, or uncertainty around policy, that generally the consumer is feeling less confident than they were probably at the end of last year.
Yeah, you're 100% right. But it's not just the consumer. So you've got businesses treading pretty cautiously as well. And if you can measure that, you can look at the Atlanta Fed's GDP Now model. Yes. And that forecasted a 2.3% quarter one growth if you looked at it sort of late last year. And now that's been slashed to negative 1.5 from positive 2.3. Yeah. So why is that? Well, once the model incorporates weaker trade data, declining consumption, the things we just discussed, look, there's also other factors, right? It's not trivial. You get cold blasts of weather in the US and you get disruptions. You can get a weaker print, but it could be the early signs of a pattern emerging. And your point was 100% right, that government policy is a major source of that uncertainty. If you're in business, what have you done over the last 4 months? You've rushed to import goods ahead of proposed tariffs that are coming. So you saw that record surge in imports, but that's now weighing on GDP. Okay, so that happened late last year into the beginning of this year. And then at the same time, of course, you've got federal employees, contractors, and other people, particularly around Washington, that are feeling the pressure of government cutbacks. Okay, and that's a group that collectively impact millions of households. So it's understandable that the data is looking weaker. And I think we'll just have to monitor it over the next few weeks and months. Yeah. And I think, what I alluded to in the little intro, that right now you've got another factor compounding that issue, which is tariffs on Canada and Mexico, which are set to take effect today. Yeah. Now, we talked a bit about China on the last pod, that my view is certainly that China is largely Trump-proof. Yeah. But the big stories, as I've said all along, are Canada, Mexico, and the European Union. So a 25% tariff on Mexican and Canadian exports is not trivial. Yeah. And financial markets have already reacted with the characteristic volatility you expect. And you've seen the same thing. The S&P's dropped, the dollar surged, and I think this is just going to reinforce the hesitation. And that's where we are right now. It's hesitation, cautiousness, and a little spike in volatility. But it's more about this gradual creep effect, this rising of uncertainty over supply chains and input costs. That tends to have a much longer term effect. And then households are bracing for potential price increases. Okay, that's why you've seen the savings rate go up and consumer expenditure drop. So I think we need to see the effect of these. My view is that it will depend on, particularly with tariffs, on three things. It will depend on the duration of them. And I talked before about how I think the Turkey steel tariffs that were in the last Trump administration were only in effect for about 63 days. So we don't know how long these will last. That's point one. Point two is that there's an element of statecraft here, that the government might maneuver There could be exceptions with particular companies. I gave the example last time of how Apple negotiated exceptions, and there will probably be a long list of others, particularly when it comes to Canada, when you have, as I've talked about, cross-border trade in oil, cross-border trade in electricity. That is quite critical here. And then you've got consumer price sensitivity. Okay, let's see to what extent this impacts the consumer. So I think, again, no answers today, but we're painting a picture here of just increasing uncertainty and the propensity for volatility. But it's like an oil tanker. We're not changing we can't change the direction of the ship today just because tariffs are announced. We're going to have to watch this data unfold over the next couple of weeks and months. I
noticed there was an announcement that TSMC, the world's biggest chip maker, is going to be unveiling a $100 billion investment in chip making facilities in the US to obviously circumnavigate tariffs. And from going back to the point of view of sort of hard data, we've got the non-farm payrolls published towards the end of this week. This after we recorded, I should say. And obviously that's going to be a key piece of data as far as the Fed is concerned. And that will give us, I guess it's a bit of a lagging indicator, but it will give us a sense of the health of the US economy. Yeah, I mean,
those numbers sound really big. The investment numbers, I mean. But remember how difficult it is. Like, so much of the world's supply chain when it comes to these kind of components is either in Taiwan or in Korea in the case of LED screens. And then you've got battery tech, obviously, in China. It's very difficult just to start wholesale fabrication in a whole different part of the world without a massive investment. And I think when we did the pod last May, someone can fact check me on that, it might have been April, when I talked about the recent unveiling of a new, I think, Intel plant that at the time that was being built in one of the Southwest states in America. The stat I used was it takes something like 200,000 miles of copper wiring to build one of these plants. Like, yes, the investment numbers are enormous, but we're talking here, listeners, about one of the most complex production facilities we've ever produced as a species. With the kind of cleanliness that is hundreds, if not thousands of times more clean than like the cleanest operating theatre. Yeah, they are. They're some of the most sophisticated production plants. So these changes, even big investment numbers and big gestures like that, won't come into effect in terms of actual output for years. Absolutely years.
Okay, I mentioned the Fed. Obviously, our third topic is inflation, and it's tricky because we've got concerns around growth, but inflation is still remaining sticky in some areas. And I guess how that's playing out in the bond markets and volatility in bond markets at the moment.
Yeah, so look, you've got this volatility feature in bond markets, which I've talked about. I reckon if you went back and punctuated how many times I said there'd be either rate cuts or rate rises over the last sort of year, they would probably all net off. We've gone from a situation where it looked like the Fed was going to hold rates to a situation now where there's a few concerns about growth. And now you've come back into the zone where you're looking at, as of today, around 3 rate cuts priced in for this year. The point here, I think, is that let's all be, yes, the bond market's volatile as it has this tug of war between early indications of weaker growth, but also sticky inflation and tariffs, and the interaction between those two is a bit like a fulcrum. You've got to decide which is going to have the more dominant effect. But the US economy is just a massive tanker ship. Okay, it's still moving forward, but what we're talking about here is the warning lights on the dashboard that the Fed are looking at. So you've got consumers. What would the Fed be watching? Consumer spending slowing, business confidence wobbling, jobless claims, certainly in the DC area, rising, and then now tariffs set to raise costs. So the next few months are going to determine what the Fed's going to do. So I think that's the dilemma for them. If growth slows, does the Fed cut rates to cushion the impact? Well, no, not so fast. I mean, inflation's cooling, but not convincingly. The Fed's preferred measure, this PCE index, fell to 2.6 in January from 2.9 in December. So progress is going in the right direction, but this last bit of inflation has been painfully slow. And then on the other side now, you've got the risk of import tariffs pushing prices higher. So, I mean, you add all that into the mix and you get this sort of uptick in consumer inflation expectations. So I think the Fed's got every reason to stay cautious. Yes, the market's pricing in now an extra cut than where we were about a week ago. And I think I think what's really the big driver of this inflation debate now is going to be Canada and Mexico and tariffs, because economists tend to differentiate between the immediate impact of tariffs on prices. Yeah. So remember the level effect. Remember, I give the washing machine example. Yeah, you add a tariff, the price goes up, and then it continues its downward trend. And then the longer term inflationary consequences. That's the inflation effect. That's as businesses pass on the costs and it's more accretive. And I think, unlike past tariff cycles, so the first administration, the gap between price increases and inflationary pressures is likely to be shorter, right? So I think businesses are more cautious. And I think what 2021, 2022, what that surge in inflation taught businesses, is a pretty harsh lesson. It's the need to react faster to supply chain disruptions and rising costs. So if I'm looking at there's a number of reports that I read, but you're seeing anticipatory price increases already. So I think that the story here is the tug of war between growth and inflation.
Yeah.
Remember, listeners, when it comes to supply chains, as I've talked about a lot, it's really complex. The level effect, like the one-off increase in price, from the longer term effect. It does depend on the market. So the region, the market, and the actual good, and the inelasticity of the demand for that good. I think, to bring it to life, I was looking at the one that I've referenced a lot, which is the automobile, right? Remember the idea of the cross-border tariff applied to a car that's built in both Mexico and the US and maybe crosses the border 8 times. Yeah. I found a really good example, a General Motors Silverado, which, 31% of the 673,000 of these that are made every year, 31% of them are built in Mexico, 20% of them are built in Canada, with the remaining, let's say 50% built in Michigan. But wherever they're built, the power steering, the door trim, that comes from Mexico. The rear lights come from Canada. The airbag comes from Germany. And the center display comes from Japan. So it's so complex.
Yeah.
The impact on inflation is going to be different depending on the good. Okay.
Yeah.
So I think that the Fed isn't going to react too quickly to this creaking in growth that we've seen. They're going to be watching on the level effect and the inflation effect of tariffs. But the market, which is much less, let's say, politically inclined as the Fed, or perhaps less, no, a better way of phrasing it is not quite as cautious as the Fed, is pricing in 3 cuts. But to your point on volatility, that could change next week and we can be back to 2 again. So we're going to have to let the data come through.
Are we in danger of the US economy entering into a sort of period of stagflation?
Yeah, well, that's the big risk. That's what nobody wants. Stagflation is a really lousy
just explain what that means, just for those that don't know.
Yeah, simply put, it's rising prices and slowing growth. And the assets that tend to work well in stagflation are few, but they tend to be real assets. Sort of infrastructure, things like that. It's very, very tricky, stagflation. But the good news is, absent the late 70s, where you had the oil price shock, the periods where we have had stagflation are almost technical, right? That you would never, yes, we can measure them, and there are a few isolated periods over the last 15 years where we've had stagflation, very short-lived, and almost technical. Like, you wouldn't know it. We're not, for those listeners who are old enough to remember the late 70s, that wasn't a technical period of stagflation. That was an acute period of stagflation, but that was one-off due to the structure of the labor market at the time, and also the structure of energy dependency in one particular part of the world at the time. So there is a risk of stagflation creeping in, but I think if you look at the best models on the complexity of tariffs and their effect on inflation, the numbers vary, but at the moment you're looking at an upside addition to inflation in the order of around 0.2 to 0.3%. You're not talking about a wage price spiral. You're not talking about the kind of inflation numbers we saw in 2022. You're talking about a modest upward sort of bit of sticky pressure on prices. But again, everything depends on those 3 things. duration of the tariffs, the statecraft and government maneuvering, and the maneuvering of corporations to avoid them, whether you, as a government, or you start diversifying your bilateral trading with countries that aren't affected with tariffs, or as a business you do that, or perhaps you negotiate an exemption. And then you've got just consumer price sensitivity. It does depend on the good. So I think that the Fed will be cautious, and they'll walk that tightrope between inflation and growth, and they'll want to see the effect of some of this policy before they take an action.
Okay, so it's fair to say they've got an eye on both, as you said, but they're probably slightly more focused on what's happening with inflation at the moment, because they're mindful of how current policies could impact inflation. And that's really their number one job, is to make sure that doesn't get out of control.
Yeah, and the Fed have said all along that, look, okay, they've got a dual mandate. They have a growth and inflation mandate, but the emphasis right now seems to be more on inflation. There's lots of moving parts here. You have government expenditure being cut as well, okay, and that's not just a direct reference to federal employees that are losing their jobs. It's also some programs that have federal budgets that are being cut. So the Fed will want to see how all of these factors play before it takes any view on growth. Right now, you're right, it's leaning more towards its inflation half of its mandate.
But I think what the key thing for me here is that this narrative is going to keep shifting, because, as you say, we started the year with the expectation of maybe one or two cuts. We're now we're only in month 3 of the year, and we're already now saying, well, actually, there could be 3 cuts. That's going to change again, isn't it, from month to month?
Yeah, I think so. Until we settle on, I have a particular view of tariffs. Remember, that view is based around where the gravity of economic activity is happening in the world, and the dependency of the US on Europe and on Canada and on Mexico. It's not a zero-sum game. So I've got a view that ultimately this is noise, and the pendulum will keep swinging tariffs on, tariffs off. But the noise itself is a source of uncertainty. So I think as time goes on, we have to see how much of that uncertainty becomes permanent, right? Because if you're a business and you're thinking of investing right now, or you're a consumer thinking of making a big purchase, you're probably holding off a month or two.
Yeah. And is it fair to say that if we contrast bond market reactions to what's going on at the moment to equity market reactions, the bond market reactions are more perhaps analytical, less sentiment driven? Is that fair to say?
Yeah, I mean, it's the age-old saying that the bond market's sort of where the smart money is. I think that's right. I think the bond market is much more analytical in that sense, and it's simply pricing in a slightly weaker growth story, and the need for the Fed to react to that. So you've seen yields drop since the beginning of the year.
Yeah.
Particularly the long end of the curve, which is where Bess and a number of people, like the current US Treasury Secretary, are focused. The equity market is, we have a State of the Union address this evening, so it is not beyond the realms of possibility that the equity markets might react to something that is said in that address. Yeah. That's different to decomposing growth and inflation statistics and then pricing a government bond accordingly, which is what the bond market does. So yes, you're right. It's the equity market's more emotional, and the bond market's more analytical, more computational almost.
Okay, certainly. I know one thing for sure: we're definitely going to be revisiting this topic almost on a weekly basis, I suspect, because as things keep moving and changing.
Yeah, I think we should, and I think we should sort of come back and perhaps look at some of the effects of tariffs, because it will be interesting, I think, to see it in the data, and then we can decompose the different regional impacts of it.
Yeah. All right. On that note, thank you very much, David. And a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. As I said, thank you, David. Thank you for listening. Until next time on Need to Know, bye for now.
you.